It's Friday, February 21st, 2025, and you are on the market with Chris Sipes CFP and sitting in for Darren Blonsky, myself, Dano Weir, the Marketing Director for Sonoma Wealth Advisors. Chris, this is going to be a super easy show today because nothing has happened this week. Totally dull week. No activity in Washington. So I'm ready to just cruise.
Yeah. Well, Darren and I used to joke that, he wasn't allowed to go on vacation because whenever he did, the market went down. And
The last
strangely
vacation
enough,
the last vacation he took was that flash crash in August.
yes.
And so
So don't
it
worry,
is literally
everybody.
every time.
There's nothing going on. It's just Darren's on vacation. So this had to happen.
We're going to take a look at the market and some great expectations, perhaps, that have been in play this week. But first, this. Now, Chris, rare is it that I've got more knowledge on the markets than you on something, but I get to set up this meme because I know Zoolander, buddy. I know Zoolander very, very well.
Okay. I was hoping you would, because to be honest, I'm a little embarrassed to admit this, but I did not know what this was referencing. I just knew that you probably would. And so I threw you some red meat. So go
just
ahead,
for
Dano.
me, just for me.
Yes. Go ahead.
It's an amazing movie in the late 90s. I think it was 1999. Zoolander, Ben Stiller, Owen Wilson, Will Ferrell, and it's about how ridiculous fashion culture is. And if you don't know these pictures, Owen Wilson and Ben Stiller are Hansel and Zoolander. That's their character names. They're rivals in the movie, right? And so they're always, for at least the first half of the movie, spoiler alert, they become friends. The first half of the movie, they're always like, they're squaring off and they're having like a fashion off. And this is so funny because so we're looking at, we've got Zoolander is gold and Hansel is I bet. And what I think this is saying, Chris, is that you've sort of got two, call it alternative asset classes that are sort of squaring off right now. Is that what I'm seeing?
Yes, I that was what I was assuming. Based on the person who posted this meme, which was Eric Balchunas, and I think so. The theme this week is great expectations, because I think one of the things we want to continue to hammer home is that the investment market works based on expectations and how those assets and things turn out relative to expectations. So a way I like to think about this is kids, right? And if you don't have your own kids, you've probably seen this play out in other families where you've got say the same parents and they've got 3 or 4 kids. The kids act differently. So the expectations for, let's say they've got the one kid who's always turning their homework in on time, maybe skipped a grade, never does anything wrong. Their expectations are very, very high. So anytime, they do something wrong, everybody's devastated because their performance relative to their expectations was way off, right? And then vice versa, you got the kid who's like, you're afraid to take them anywhere because they're just gonna, who knows what they're gonna do, right? And then they surprise you
or whatever.
Yes, behavior issues, like it's just one thing after another. And hey, they act just basic and normal, but relative to the expectations you had for them, it was a huge win, right? And so
Right.
Markets work the same way. It's not what is a lot of times people say, well, that's a great company, of course, but the expectations of the market is that that's going to do great. Now, I think, one of the things that I personally think you want to look for is assets that are doing well when the expectations really aren't there. Like nobody's really talking about them. And to me, gold is one of those where it's had an amazing year. It's had an amazing 5 years. Still nobody's talking about it. Nobody's really flowing money into it. Of course, everybody talks about Bitcoin. The expectations for Bitcoin are super high, and gold's like this forgotten, like, who really cares, right? And so there's a theme, I think, of that in the asset markets right now, where you're starting to see some of these asset classes that really had no expectations doing pretty well, while the assets that have very high expectations are starting to struggle a bit. So I think this is also really interesting, Dan, where we are pretty close to all-time highs in both the S&P and the NASDAQ. So the main US markets that not only everybody in the US watches, but also people globally. We're very close to all-time highs, 1 or 2% off. And yet the bearishness is really high. And that's not normal. Normally, when you're hitting price highs, you're seeing bullishness highs. Everybody's excited and happy. And over these last few weeks, that's not been the case. There's been a bearishness in the market, in the sentiment. The CNN Fear and Greed Index is down to 36, which is fear. That's down even from 44 fear of last week. Bitcoin's up to 55, which is just past neutral, so it's really not too much. But you and I were talking before the video that we've had a lot of people, just anecdotally, clients reaching out like, hey, I'm worried about what's going on, what I see in the headlines. I'm worried about the markets. What do I do? Right. And I think that's fair. That's always fair. There's always going to be things in the market. There always have been things in the market that we're always afraid of. Right. It's a tempting thing, I think, to think this time is different because we're experiencing it and not, it's not a historical experience. However, I think, these things have happened before. And it's a reason why, professionals, investors, tend to say they preach diversification because you don't know what's going to happen. Bull markets happen all the time when you didn't expect it. Bear markets happen all the time when you don't expect it. That's the way markets work, because if everybody expected a bear market, everybody would just get out. If everybody expected a bull market, everybody would just get in, right? So diversification is an aggressive strategy because you're going to catch the up markets, you're going to catch the down markets, but not in a way usually that creates huge whipsaws. So staying diversified is your best defense against market turmoil and against missing the upside.
Yeah, but it's also boring. I mean, come on, Chris. I want that one thing. I want to ride that rocket ship and it's going to go up, right? I mean, that nobody wakes up in the morning and goes, "Gosh, I really want some bonds today." I just
right.
Things are going well and I could really go for some bonds right now.
Yeah.
But gosh, you might like those when perhaps we feel like we're at an all-time high and it's about to fall.
Right. You don't go to the party and say, "Hey, Dan, how's your fixed income portfolio doing these days?" Just not going to happen, right? So we got
my CD just matured and I'm loving it.
Yes. Yeah. What are your rates on your money markets these days? Wow. So we saw
hot tip money market.
we saw a sell off in markets today, and that was possibly due to really anything. But one of the things was consumer sentiment came in lower than expected. So again, relative to expectations, it was lower. The consumer sentiment came in at 64.7, and the consensus was closer to 67.3. So I think it's interesting. Look at these numbers. We're down where we were in the great financial crisis. We're down where we were at the beginning of the bull market in the 80s. We never got an official recession from 2022, but there are so many numbers under the surface, indicators, different markets where if you were just shown a chart like this and you didn't know that the stock market was near an all-time high, you would say, oh, geez, we're probably in the doldrums, right? And consumer sentiment is one of those. So we saw a big reversal in consumer sentiment. Inflation expectations went up quite a bit, maybe due to the tariff talk. I don't know. But that slowed down. And then we had the global services flash PMIs, which is like the preview of what the PMIs are going to read. The Purchasing Managers Index came in at 49.7 versus a consensus of 53, with 50 being the expansionary line. So above 50 is an expansion, below 50 is a contraction. And we got 49.7 on that services PMI. And on the composite PMI, we're at 50.4. So just barely expansionary. So, hey, look, markets are made up of people, and how people feel is very important. It doesn't drive everything, but it does have an impact. And those are some numbers that didn't come in so great today on Friday.
Chris, I wonder if you
21st.
could tell me, because I know last week CPI came in last week, and I know that it was hot. So that was one thing. And now we've got consumer sentiment. Consumer sentiment is measuring what? Is this a poll? Is this this is one I've seen the headline of a lot this week. How is this measured? This number 64. Do you happen to know?
It is a poll, and it is it's run by the University of Michigan, and it has been for a long time. And they survey people. Now, a lot of people say that this has really lost a lot of its efficiency or effectiveness because it's become extremely political. So if you poll Democrats, they're in the absolute everything is awful, market's falling apart. If you poll Republicans, things couldn't be better. And so it's literally like two completely different perceptions of what's happening. And that's developed, over the last few years. So a lot of people are saying, hey, these sentiment, polls aren't really useful anymore. Now this is from Liz Ann Saunders, and maybe a reason why inflation expectations are going up. She says there are more cars imported from Mexico than the next two countries, South Korea and Japan combined. That's not something that I knew before I saw this chart. I would not have expected that. And, we Americans have a love affair with cars, that's for sure. A lot of people take 6-7 years to pay off a car, 8 years, whatever. We feel the need to have new cars every couple years. And so it's going to be a major purchase item in addition to houses. So if, outside of a house, probably the car is the second biggest purchase for most families. And that could be a big driver of those inflation expectations moving forward is, hey, if we're going to be paying, say, 25% tariffs, or if we're in a global trade war, that car is probably going to be more expensive than what we would have expected to be a year ago.
Right. And I think something to consider too, I can't see the methodology per se, but if a car is created by Daimler Chrysler and it's hecho in Mexico, is that really an import? Is that it's an American car, which would speak to, not getting political, but that would speak to why some of those tariffs are, that particular party is looking to enact those tariffs, is they're trying to get that business to be made back in America. So that would be their goal. But this is, I don't want to say it's misleading, but it definitely there is not a Mexican car company that's creating cars that is,
No.
these are American companies making them in Mexico.
Yeah. Yes, absolutely. Or at least parts, right? So, I thought this was interesting. This is from Bank of America via Mike Zaccardi. With all the headlines out regarding the government and, the government cuts and everything through Doge. And we've talked a lot about, hey, our debt to GDP is not sustainable. Our deficits are not sustainable. We've never run deficits like this outside of recessions before. So the U.S. government's financial situation is a concern. Now, Darius Dale was on, with Macro Voices this week and just talking about, hey, they're not going to be able to cut that much, because when you look at what we actually spend money on, about 2/3 of it is this mandatory spending that you see there at the bottom: Medicare, Social Security, veterans affairs, et cetera, education, those things. That's where the bulk, 2/3 of the money is. And then the other large piece is defense, and interest payments on the debt. Two things that you could argue, like, can we cut a lot there? Maybe, I don't know. Maybe there's some waste in defense, but you can see that's less than $1 trillion of the total spending as well. So out of our 1.8 deficit, we're spending more than we're bringing in, and we're doing that at a time when markets are doing very well. So, and the economy is doing well. So tax receipts are higher than they would be in a recession type situation. Where are these cuts going to come from? Because I think in theory, it sounds great. Like, let's cut. But usually people get a little, yeah, but I didn't think you were talking about that when you start talking about your thing, right?
Right.
So
yeah,
how much
and I
room is
think the number that's been floated around for Doge, for that department, if it is a department, is 55 billion, which sounds like a massive number, until you compare 55 billion versus that red box there, in which that's a tiny drop in the bucket. So that doesn't even get to the 0.1 category. That doesn't even get to the 10th category of the 1.8. So,
right.
Who doesn't love the idea of, quote, cleaning something up, whether it is or isn't? But if there's this, if you're thinking that Elon is going to eliminate that red box by finding all of the waste, that's not going to happen. At least not this year.
Well, we've been building this beast for a long time, and you can see this goes back decades. And Biden was definitely not the first president to deficit spend. He's definitely not the first one to add to the government debt. It has basically been doubled under Bush, under Obama, under Trump 1. It was doubled again under Biden. So, like, it's been added to by each party, and it's been added to over decades. So this again is from Bank of America, showing the U.S. government expenditures as a percentage of GDP. And you would think World War II would be, kind of the high point. I mean, we're literally fighting a world war, an all-out war. And yet that's really kind of quaint compared to where we were in COVID. And you see the overall trend line. I mean, we've built a monster, and taking control and making changes on something like that without, especially doing it quickly, I think is that's a tall order. It's going to be really difficult now that it's so intertwined with our economy, with the global economy, with global markets. Doing so quickly is really tough. I mean, this is something that's going to take some time when you look at the expenditures that we've built up over time, to get to where we are today.
And Chris, I just want to say first and foremost that I can say with certainty, and we rarely can use the word certainty when talking about the market, but I can say with certainty, Chris, you are the only stock market show with a slide with the Civil War mentioned on it this entire week. So congratulations for that. I would expect no less of you. And this is really great. This is really great perspective.
Yeah, me, I'm a sucker for any chart that goes back into the 1800s. They usually only go back to the 20s, and 1920s. So when they go back to like the 1820s or even to the 1700s, oh, I'm in. I want to see that chart. Now, initial claims really haven't budged yet. Now, this is a 3-year look at initial claims, and we're still, like, in that 220 range. The reason I couldn't go back further is when you show the chart, including COVID, it distorts the whole chart to be able to tell, like, is this kind of like normal? I would say, in terms of initial claims for unemployment, it really hasn't, these cuts that are coming through haven't affected the data so far, right? So, you wonder, are the headlines what's actually happening or not? These days you can't really tell, and at least so far with the initial claims, they're not coming through yet.
I think something to keep in mind. I'm glad you mentioned headlines. I've got some key words I think that are great trigger words to watch out for when it comes to headlines in the markets. Any headline to me that says plunge, dip, crash, slide. As soon as I see those headlines, I just immediately start turning off any emotion or really take it very seriously, because there's just this casual note for an investor. News media, as we've said many times, is designed to whip you up into a frenzy to probably make you buy the heartburn product that's also on sale on that same website page. So just a note to take all the headlines with the biggest grain of salt you can find.
That's so true. I listened to a great interview this week that I really want to highly recommend for anybody that's interested in diversification, which I'm sure there's maybe one person out there. It was Larry Swedroe on the Excess Returns podcast. And Larry is he's an investment professional that's been around for a while, written several books, and he talks a lot about the history of the markets and why it's a very logical and smart thing to be diversified. And one of the things that I guess I knew, but I was shocked to kind of hear it, was the S&P has spent roughly a little less than half of its time historically with zero returns, while the other half was what generated that average return of 10%, call it, roughly in that range over a 100-year period. So very rarely does it actually hit that 10%. It's actually about half the time it's zero or negative, and the other half of the time it's multiples of 10, right, to get that average. And so that's why he talks about, look, there's been historically many times in history where the S&P has done very, very well for many years in a row, and then there's been many times where it's done very poorly for many years in a row. Right now, I would say that the S&P has those great expectations. It is the kid that everybody expects to go to Harvard, go to med school, all the yada yada. I think that's still like the expectation of the top kid. I don't know. Maybe that's not the case anymore. But those expectations are priced in. So this is from Bank of America. Again, there's a lot of good slides from Bank of America this week. And they say, is the S&P 500 expensive? Statistically speaking, 19 out of the 20 metrics give an emphatic affirmative response. Now, to be fair, they said the same thing in 2024, and 2024 had a very good year. So timing these things cannot be done. I'll repeat that. Timing these things cannot be done just based on valuations in the short run. But historically, in the long run, they've tended to mean revert because, look, sometimes that kid ends up dropping out of college and, touring with the Grateful Dead or something, right? So they don't always go to med school and finish off, and so when the perfect outcome is already priced in, to me as an investor, that's when you say, okay, maybe I should be looking at some other places where, let's invest in. Hey, if that kid just acts normal, that's a huge win, and we're all celebrating, right? So, anyway, end of rant on that.
Well, I think you reiterated there several times. Timing these things is not possible. Timing these things is not possible. And so what that means to me, you mentioned last year was a pretty good year for the S&P. 24 was a pretty good year for the S&P. And yet there was so much, quote, uncertainty last year because of, quote, the election. So someone could have said with those pieces of information, I'm going to sit this year out until things, quote, calm down. That's a very common thing that people say. It's a common refrain. Well, you would have missed out on a pretty good year in the S&P. Well, that's easy to say now looking back. Think about that now, today for 25, looking forward. Yes?
That's exactly right. And the flip side of that is also true. You cannot time when you think a market crash is coming, right? Based on valuations, based on headlines, based on anything. That's proven as well. You know, the flip side, if you can't catch the upside because of the timing, you also cannot avoid the downside because of the timing. What you want to do is get into a portfolio that you feel pretty comfortable with the range of outcomes that could possibly happen, right? And if you're someone that says, "Hey, you know what? I got ice running through my veins. I don't care if I wake up the next day." You know, these Bitcoin investors that have been in for a while, like they wake up in the morning and half their portfolio is gone, and they're like, "Oh well, it's just another Tuesday," right? So it's it depends on the investor. So if you're not that way, then hey, diversification, owning other asset classes makes a lot more sense. And one of those to consider that the expectations are so low on. In fact, a lot of people say, why even own international stocks? Well, this is from Wes Gray at Alpha Architect, and he says the post Great Financial Crisis period has seen two major divergences in valuations that has led to divergences in performance. That was actually from Larry Swedrow's article on Alpha Architect. But I know that AQR did a study as well, saying that, look, the outperformance has been very little because of the fundamentals, i.e., the US has better companies, and a lot more because the prices have gone up. The price to earnings multiples have gone up. So the expectations have gone up. The people feel more comfortable investing in the US, et cetera. So what Larry Swedrow goes on to say in his article is, to quote Cliff Asness from AQR, for those investors willing to be contrarians, they might, quote unquote, sin a little by overweighting international assets with the expectations that valuations will converge. Now, again, not a timing thing. This has been the case for several years where international stocks have been much cheaper. Now they're vastly outperforming so far this year, but that's what 7 weeks into the year. So it's too early to tell, of course. But if you're thinking to yourself, gosh, I need to get out of the market because I'm worried about what's happening, maybe it's better to say, maybe if I dial back on certain investments and, dial up on some of these other investments that I never even thought about or wanted to consider, because, the thought of investing in international markets, just, again, you're not walking up to the barbecue, say, "Hey, how are your international stocks doing, Dan?" Not going to happen.
Right. Right. And something else to consider too is the put it all in cash idea, right? So I'm freaked out about, people don't say this either. I'm freaked out about the market. They don't say what they really mean, which is I'm freaked out about the US stock market, right?
Mm-hmm.
They don't say that first part because they don't think of anything else. And
Right.
going all cash has its own risk, opportunity risk, and look at the inflation numbers. Look at every day that you're sitting in cash, all cash, your dollar is worth less every day, and the inflation numbers prove it.
That's right. Now, this chart, again, from Bank of America, they had some bangers this week. They have the Euro Stocks 50. This is the Euro Stocks 50, so the blue chips from Europe. But Dan, you could remove you could remove the name of the index, and you could remove, that this was from 1999. And this could represent several different markets from past years. This has happened in the US. This has happened in Japan. This has happened in probably every major stock market. I don't know this for a fact, but I would guess that it's pretty close to every major stock market in the world has gone through a period of 20, 25 years with no return. This just happens to be the euro's time. So this is another argument for diversification, because imagine, in 99, you're a European, and you have a home country bias. You invest all your money in the companies that that you feel are the best because you use them every day, right? And here you are 25 years later going, geez, I went through some huge drops. I didn't make any money over that 25-year period, right? So again, the way out of that is diversify. Don't put everything into one market, because this happens a lot throughout history, and it has happened several times in the United States too. People just forget that. So expectations, not there, right? The European markets have done very well so far this year. It always perks my ears up when things are doing well, despite the fact that there's no hype, there's no flows, nobody's talking about it, et cetera, et cetera. So they're showing here the Europe-focused equity funds have seen 561 billions of outflows since 2005. Nobody's investing there, and yet the market's going up. Okay, that's got to perk your ears up a little bit and say, interesting. Is this a case of the expectations are so low? I took the awful kid to the restaurant, and they're sitting there quietly eating their food and drinking their milk. Right? Interesting. I'm so pleasantly surprised.
Okay, now Chris, I have to stop you because Chris, you have a dozen children. Cheaper by the Dozen is actually based on you, and you keep talking about kids' behavior. I feel like maybe there's is there something going on? You got a crybaby in the house? What's going on?
There may be some Freudian slips going on. I don't know, Dan. Maybe Freudian slips. Yeah. So same with Bitcoin versus gold. So this is from Eric Balchunas again. He says gold has been on fire, a near record start to the year, and up 45% in the past 12 months, which is double the NASDAQ, by the way. Yet he puts in all caps, no one cares. Virtually no flows coming in. Odd. Most likely theory is that Bitcoin ETFs have stolen all their thunder and dollars. And this was via somebody that goes by Sorophagus, I think I'm hopefully saying that right. But anyway, another situation where, hey, there's an asset class that's doing really well despite not getting any flows. Nobody's talking about it. Nobody cares, right? Literally no one cares. And yet that asset class is doing really well.
There's Trish, can I share? I used to work in radio, so can I share a story with you about radio real quick?
Absolutely. Go ahead.
This is going to seem out of left field, but it's related. So in radio, if you've ever been driving in your car, and you'll see that some stations, when you're listening, if you still listen to FM radio, or perhaps you did in the far, far past, some stations, the name of the song and the artist will come through on the screen of your car. And it was new. It felt new. That's like in the late 90s into the 2000s. Suddenly you could get like the artist information on your car. What is that? It's called Radio Data System, RDS. And it's kind of cool. And there's actually a lot you can do with it. And actually the station itself can program in messages. But station to station, it was a mess, and there was all kinds of different standards, and that's because there was no governing body that was managing the whole system, like the FCC would have managed, say, television in the 60s, 70s, 80s, etc. So basically, it was this cool thing that a few people were doing stuff with, but there was no governing body pushing an agenda, no governing body that was, lobbying in Congress for stuff, and so it just kind of existed, and no one talked about it. This is the same thing as gold. This is exactly the same thing as gold. If there's no unified, interest that's pushing it as an agenda and paying for it to be on the news, then it's not. It just is, and you can either recognize it as an opportunity, or you can go, oh, okay, well, what does the headline say I should do? What do you think?
Yeah, that makes a lot of sense. Now, should you dump everything in gold? No, I don't think so. Right? It doesn't mean pile everything in there. Here's the Russell 2000. So U.S. small caps. This is from Charlie Bielo, showing the number of consecutive days. This is from Kevin Gordon at Schwab. Number of consecutive days that the Russell 2000 has not surpassed its prior high. So we've been on a very long streak where, U.S. small companies have been in the doldrums, sideways. So yet another market where you can be sideways for a long time. Now, it looks like it's only been exceeded twice, once in 2008, once in 2000, despite the fact that we, quote unquote, didn't have a recession. There's areas of the market that would seem to have shown at least a rolling recession along the way. Now, some of the other news that we got this week was the existing home sales were also lower than what were expected. This is definitely another area of the market where you've definitely seen a recession in the real estate market in terms of home sales, especially on the existing home sales. Look at that, Dan, down back where we were in the great financial crisis. And we've been here for at least a year, maybe longer. So trading sideways on those existing home sales. And we're also just to remind you, with the new home supplies, which is the yellow line, this is, orange line, month supply, 9.5 months. So anything over 9 tends to be too much supply, and where you start to see prices lower, and under 3 is where it's too tight. The supply is too tight and prices tend to go higher. There's just not enough supply. So as you can see, historically, we've not had a situation like this where there's been such a bifurcation between existing homes, which nobody wants to leave because they got their low rates, thanks to COVID and the government intervention in the mortgage market, versus the new home sales just are not, things are not moving. So the real estate market is pretty much locked up. And Charlie Bielo here showing the housing inflation cumulative percentage. He says the monthly mortgage payment needed to buy the median priced home for sale in the U.S. has nearly doubled in the last 5 years. This remains the most unaffordable housing market in history. Now, to me, this is probably a source of a lot of the political upheaval in the United States, is the fact that I think I saw a stat the other day that the average home buyer age, first-time home buyer age now is like 50 something. I don't know if that's right, because it feels like that couldn't be right. But nonetheless, home prices are just unattainable for a lot of people when you look at it relative to incomes these days. All right. So Darren messaged us that he actually fell asleep during this first part of the presentation. So hopefully this will wake him up. We're going to get some lines. No candles this week. Sorry, folks. Don't have the system that Darren has, but we're going to get some lines and charts. And so, Darren, if you're still listening, wake up. We're coming back. Now, so starting off with the S&P. Now we're using the S&P futures, the index. So you can see here that despite the sell-off today, when you look at the 50-day and 200-day simple moving averages, nothing to write home about. We did not break that moving average on the 50-day. So we're still in an uptrend. Usually when you see the tracks, like a ski track on the way up, hey, there's nothing to worry about, at least yet, in the S&P. So despite the sell-off today, nothing changing there. Same to say with the NASDAQ, checking in with that 50-day moving average, but still a lot of upward momentum. And that's, again, why you say, hey, despite the evaluations, despite how you feel about the headlines, et cetera, when you look at the technicals, no signs of weakness on the horizon yet. Then we've got the bond market. Now, this while it doesn't look like the NASDAQ, it doesn't look like the S&P, you don't have the ski tracks going straight up, but hey, at least you don't have the ski tracks going straight down, which is what bond investors are used to seeing over the last 3 to 5 years. And so we've got the ag possibly on the move. Interest rates were down today. Bonds were green because of that. Remember the teeter-totter, rates down, bond prices up, rates up, bond prices down. And so bonds providing a little calm in the storm today, thankfully. And then we've got the MSCI ACWI, which is the ex-US and ex-US indices. So basically, as it sounds, not the United States, but the other countries. And again, wow, that looks pretty strong, Dan. We've got the upward sloping ski slope, ski tracks again, and we're not even close to the 50-day moving average. It seems like it's chugging higher. And what's interesting is that the emerging markets are actually doing pretty well for once, right? And specifically China. I don't know what is happening over there at the moment, but I do remember that being uninvestable not too long ago. Turns out, at least in the short run, that was a
so-called uninvestable.
That was the kid you left home every time. Just leave him home. I can't take it anymore.
He'll get us kicked out of the restaurant.
We're going to get kicked out of the restaurant. We can't even take him. All right. So then we've got gold. Gold again. Wow. We're actually getting so far above the 50-day, Dan, that I wouldn't be surprised to see gold check back in. Usually when you see those big spurts higher, it gets that whatever the asset class it is, it usually gets ahead of itself a bit. So, we're getting some meaningful separation there between gold price and the 50-day moving average. So, we might see some pullbacks there, but nonetheless, a lot of strength in gold at the moment. And lastly, we've got the US dollar index. We saw some relief there because remember, a strong dollar is difficult for asset prices, and it's difficult for any companies that export. It makes foreign goods cheaper to import, and so it makes it more expensive for other countries to buy our products. It makes it more expensive for other countries to pay us back any dollars that are either lent out to us, or if they have a loan in dollars to another entity outside of the United States. So a strong dollar can be a wrecking ball in the markets. And so looks like we're coming back into the range on the dollar, at least for now, down at 106. So that's all for this week, Dano. That's all we had on the charts, but wrapping up another week here in February, and hopefully that was helpful to go over. Apologies, I don't have a good Bitcoin chart for whatever reason. YCharts does not have that same index for Bitcoin. So I didn't leave that out on purpose. I tried to include it, but we just didn't have a great chart for it.
Well, Chris, I appreciate you so much for letting me step in on the show. I always enjoy guest hosting. Darren will return next week. And I'll just say one more thing, which is that the goal of the show, the goal of On the Markets is to relay what we're seeing and what we're feeling as we're watching various market indices. And it's educational. And something to consider is that rational advice usually isn't very exciting. A measured approach to something certainly doesn't leap off the page for your emotions like calamity and catastrophe does. And so it can be counterintuitive, but sometimes sitting there and actually looking at the numbers and walking it all through and talking it all out can really be beneficial. So it's one of the reasons that we do the show, and we hope it's been helpful for you. And Chris, thank you so much for putting it together, and thanks for being here.
Yeah, thanks for joining, Dan. That was fun.